Okay, good afternoon, everyone, and welcome to this Under the Microscope webinar with Japie from Investec. Today we're going to look at the Optimal Investment Growth Basket Limited, which is, I suppose, one of the products, and there's a very exciting slide that I think we're going to share with you as we go along. It's one that I got definitely very excited about. We've been working with Japie and the structuring team at Investec, I think, all the way back to about 2017 now. So it's been a good couple of years that we've worked with the team. And we've obviously taken up a lot of their products. This session specifically, the whole Under the Microscope series, is very much about understanding what is happening within a financial product. We do it across all sorts of different instruments, and today specifically we're going to be looking at this structured product that is offered by Investec. Japie comes with a wealth of experience. He's really, I mean, I don't know if Japie, if I can say it, but I mean, I consider you one of the people that has really pioneered structured products in the South African market. And we can see that the Investec business has been absolutely exceptional in the speed of growth in assets under management, as well as the returns for shareholders. And I always kind of enjoy pinging their team and saying, sorry, can I just get the latest updated track record? And I mean, it really is an absolutely outstanding value creator for clients. And we're happy that our clients have been able to participate over the years as well. So today, the session, we're going to go through the mechanics of this structured product. It's closing, I think, end of November, so it'll be the 24th of November. So we do have a little bit of time to do the applications, etc. But today it's really about understanding the mechanics of the structured product, understanding what the offering is, why Investec has selected the underlying, and how the product has been created. The whole reason for doing a webinar, of course, is so that you guys can ask us questions. We don't want to just to be a static information session. You can go and read a brochure, or you can go and watch a YouTube video for that. This is for you guys to interact with us, is to ask questions. So any concerns or anything that you don't understand about the product, please ask. And with that, I'm going to hand over to Japie, and I'm going to share the screen, and then we're going to just take it from there. Thanks, Japie.
Thanks, Gary.
Hopefully you can see that, and away we go.
So great. Just leave it there for a sec. Maybe for the listeners, what the potential investment then is into the ordinary shares of a company called the Optimal Investment Growth Basket Limited. Is quite a mouthful, but essentially it's a listed share. It's a Guernsey company listed in Bermuda. The selection of Guernsey is because we've got a very favorable tax dispensation on our companies. They pay zero tax in Guernsey on the assets that they invest into. Investec's role is we're the investment advisors to the company. We've done 27 of these over the last 20 years. And yeah, so it's been a very long track record. What happens with the companies, you buy a share in this company, and the share is going to last for 5 years. And the underlying currency is US dollars. During the tenure, you got a daily price. We provide liquidity so that people can sell the shares should they wish to. But very importantly, at the end of 5 years, the investors have the election to retain the shares or sell the shares. If they retain the shares, then whatever profits were made in that phase are locked into the capital protection for the next phase. So maybe let's page straight down to page 3, and we look at the salient features of the share. Yeah, that's good. So firstly, it's 5 years. It's going to be 5 years and about 10 days. So that's the term of the investment. It's 100% capital protected in US dollars. It has exposure to a basket of indices with a 40% weighting to the S&P, 25% to the Euro Stocks 50, 20% to the Nikkei 225, and 15% to the emerging markets. Now, that combination, back-tested, is 94% the same thing as the MSCI World All Country. The return is calculated as 150% participation, or 1.5 times gearing, with an index performance between 0 and 60. So for every percent that the index does, from 0 to 40, the investor gets 1.5 times that number. And we'll take you through the maths in a moment. Effectively, the minimum investment size is $12,000. And the subscription, as we said, closes on the 24th of November. So if you page down, Gary, just looking at that in a tabled form, if the index starts at 100, and the red color, the market should crash 50%, then the investor gets their $100 back. And we're going to go through the maths in a moment. The value of that, Gary, is that if that were to happen, heaven forbid, then this investor can buy the market the next morning after the 5 years with $100, and then the market's pricing at 50. So if you'd had the index to start with, an ETF or a share portfolio or a unit trust, and it went down 50%, sadly, you're looking at your statement also worth roughly 50, maybe 55, maybe 52 if it's positive alpha, or maybe 49 if it's negative alpha, but roughly 50. Here, you replace that scenario with an asset at 100. Secondly, if the market went up 20 in the middle column, the greenish column, you times the 20 by 1.5, that gives you 30. You always get your 100, so you're now at 130. If the market did 50, the first 40 of it you times by 1.5, so you'd get 60. So you get 160. And to the right is a payoff diagram, which just shows that in a holistic form. If you normally look at an investment, you start with it at 100 along the bottom axis, and you ordinarily are on a dotted line. You're on a 45-degree line, 1 for 1 up, 1 for 1 down. That's the normal investment. This investment replaces that with the blue line, which says if the market goes down, at the end of 5 years, if you stay to 5 years, you see the blue line cuts the vertical axis at 100. So you get your 100 back. If the market goes up, that's why you got a steep inclined line, the blue line, that's 150% geared on the dotted line. So effectively, if the market does 40, you max out, and you can see it's at plateaus. Reading it to the left, you get 60. So that's the payoff. Why the share? If you look at it as an investor, assuming the market over the next 5 years went down by any percentage, if you got your capital back, you'd be in the top 1% of world performance. Secondly, if the market goes up, but it doesn't go up more than 60 in the normal course of business, and you got 1.5 times it to get 60, only needing a 40 increase, you'd be in the top 1 to 3% of world performance. Because a fund manager who had to give you 1.5 times the index performance would be extremely difficult. Our statistics show that only roughly 38% of fund managers tracking the MSCI World or country, after fees, costs, and expenses, only 38%, over 1,400 funds that we checked on Morningstar, could actually give you 1 for 1 upside. So the number who can give you 1.5 times the upside is a fairly small number, and you'll only know after 5 years. So what does that mean? That means unless the world markets do more than 60%, this investor will arguably be in the top 1 to 3% of performance. So where do you lose out? You lose out if the market did 70 or 80 and you only got 60. So this, Gary, in the client's portfolios is for a part of their core portfolio. It's for a part of where they run world equities, and then they'll use you guys to supplement that by picking stocks that can give them the 80 and the 100 and the big number, where you're taking a specific risk on specific equities. If the equities are as diversified as what these are, across the whole world, the likelihood of them doing 200 and 300 is actually quite low. And we will look later in the presentation as to how it is that we design the cap at 40. So that will come to. Okay, so let's take it forward and just share how do we do this. Okay, so firstly, instrument breakdown means that the cash flow on day one, you'll see there we've put the component of the structure in a summary. Then we put the day one value, and we put the value after 5 years. So the first asset that we buy is a note. This one is issued by Morgan Stanley. And you can see there we're going to spend 72% of the capital on day one. And that will accumulate interest at an interest rate of 6.8 per annum to mature at 100. That's how we can give the client certainty that we can give them the 100 in 5 years' time. If you look at the bottom of the page, the note is issued by Morgan Stanley. We'll go into a bit more detail about the note shortly, but it captures the current prevailing interest rate, the floating rate at 4%, plus the fact that Morgan Stanley is going to have this capital for 5 years. They pay us 1.2% above the curve. So we add that, and then the Morgan Stanley note references 1/3 each, HSBC, Barclays, and SocGen, but the tier 2 debt of those banks, and that we could pick up a credit spread for that, and that's the 1.6%. So the composite of the interest rate instrument inside the company pays 6.8. And what this in simple terms means is that 72 grows to 73, 74, and matures at 100. And it's happening with no tax deduction off that interest income. Secondly, we put aside on day one 7% of the capital in a bank account, and that is for the 5 years of fees, costs, expenses, tax exemption. It costs us, Gary, for this company, which is currently worth about 2 billion rand, it costs us a total of £1,200 a year to exempt it from any tax. Now, that's quite a nice charge. We're happy to pay that one. And this means that the costs and the fees includes the advisor's fees, which in this case would be Rand Swiss, of 0.6% per annum, plus ours is similar amount. And the regulatory fees, the company is regulated in Guernsey, regulated in Bermuda as a listed share, regulated in South Africa under the Companies Act. So investors get extremely high regulatory cover and protection. All those charges then are 7%, which amortizes down to zero. You can see in the maturity column it's zero. Lastly, we have 21 left over now on day one. And what we do is that we've got a panel of 7 banks. These banks have to have an S&P A or better criteria rating. They've got to be doing business with Investec, and they've got to be signed off by a credit committee. So you're talking all the majors in the world, Japie Morgan, UBS, Citi, Bank of America, all these big banks. And we say to them, we'd like you to price for us. If we bought 100% upside to the equity market via a call option, what would that cost? And they happen to say 18%. That's the charge. We say, fine. If we sell you the benefit, if the index does more than 40, what credit will you give us? You'll see there in the middle column, that's 4. So 18 less 4 is 14. Because we've got 21 available, we buy 1.5 of them. So 21 divided by 14 is 1.5. So that's how you get 150 gearing. You don't borrow money like a hedge fund. You just take the premium and you apply the premium to what the cost is of the call spread. And that's how we get the 150 gearing. So that asset, worst case, the stock exchange crashes 40%. The call option is obviously worth naught because it's a call option. If it happened, the investor's not too stressed because they're still getting the 100 from the bond, which has got nothing to do with the share market. Okay, so what this technology does, Gary, is it actually captures on day one the prevailing interest rates, which, as you and I know, have gone up nicely now worldwide. So it captures that interest rate, what we call the duration risk. It also captures the credit spread that's available on this bank debt. And all this paper that we use is investment grade, okay, much higher rated than SA government debt. So you're capturing that 4% base rate. If an investor went and bought that bond themselves, and in 5 years' time the interest rate went to 8, they take a haircut, okay, because they lose their capital. In this structure, it has to mature at 100, so you don't lose because interest rates went up from 4 to 8. Secondly, the credit spread, in other words, the credit asset, which pays us the 1.6%, if credit spreads went from 1.6 to 5, a normal investor who bought a high-yielding bond would take a haircut. Not here. Morgan Stanley still has to pay out 100. So you're capturing the credit risk premium, you're capturing the fixed income risk premium, and then because you're accessing the equity by a call option on the equity, okay, you're capturing the equity risk premium. But nicely, you're not taking one of the 3 risks. So you're capturing 3 market risk premiums in your asset pricing process, but you're not taking the risk of any of those 3 assets. 1, if equities fall 40, you walk away from the call option. B, if the credit spreads blow out, the linked notes less about 100. And if general interest rates blow out, you still get your 100 paid out. So this is what makes this unique. Now, we've tested over all 20 years that we've done these products, and you guys have supported us for lots of that time. We've had 21 of these companies mature, and we've had 20 of 21, 95% have beaten the index. Because in the years where there was a crash, we replaced the crash with cash. Always remember, cash is better than a crash. Okay, that we've seen in 6 of our companies. Secondly, we've replaced a mediocre return, which would typically arise from a very diversified equity exposure with a leveraged upside, that geared upside. You put those two combinations together, you end up with 95% of the deals beating the market, whereas the best fund managers in the world, only 38% can beat the market. Okay, so what this really means, Gary, is that we've got this capability of blending the assets that any investor would use, but in a way where we use their benefits but don't take their risks, other than total default risk, which we'll come to in a moment. Okay, so if we page down. Okay, so if we look at the history of the MSCI World All Country Index, we've taken here 5-year rolling returns, and that's the gray line. So starting in 1982, the first 5 years would have ended in 92, and the gray line depicts a 5-year rolling return. And this is where I really have a lot of respect for people like Gary and Viv and these are trying to manage equities. It's like so hard, because you're no sooner excited and then you take a clap. Okay, then you're very down in the dumps and then it goes up and you went in. So it's extremely volatile, extremely difficult, even at 5-year rolling levels. Okay, so what happens now, we've superimposed the blue, which, Gary, I'll be the first to acknowledge we couldn't have done historically, okay, because interest rates weren't where they are now. But we can simulate it on the basis that that can give you an expectation where you typically could be. And you can see in the periods like in 1994, when the market was mediocre return, the blue is 50% higher than the gray. Further, in the periods where the market crashed, which was sort of a 2003 and 2011, 10, where that was the end of the 5-year following a down period, this thing just gave you a 0. And in the periods where there were peaks above 60, it limited you to 60. So in total, what this thing, in that little box on the right, we show, interestingly enough, equities as an asset class at price level, index price level, 23% of the time the markets were down. Secondly, at the bottom of there, we've indicated that 29% of the time, and this is quite important, Gary, 29% of the time, investment grade dollar bonds, 5-year dollar bonds, were actually negative in price. Why? Because as you know, a bond, you reduce money, you lose money if the rate at the end is higher than when you bought. Okay, so here you are. You're an investor, Gary, and I put it to you that 52% of the time, either the bonds over 5 years are down or the equities over 5 years are down. But 80% of the world's people put their money in balanced funds. Do you see how smart that is? Okay. So what we're doing is we're using the same underlying assets that the normal traditional fund management process would do. But by doing it in the way that we've done and sticking the assets in cloud where there's no tax, okay, this is what the cumulative benefit to the investor is. Secondly, if you look at the box on the right, if you'd had our product over that entire period, the average return right at the bottom of that box would have been 6.7 per annum after fees, costs, and expenses, and the market was 6.4. Now, by using the prevailing interest rates in the market, and you and I know that equities is an asset that gives you a real return above inflation. Think about what we have now. We've got a potential to get 60% over the next 5 years, which is a 9.8, 9.9 IRR. What that means is the maths has already calibrated the product from a historic average of 6.7, because it was low interest rates, to a current expected potential of 9.9, which would be another plus minus 4.5, 5 real return. So the fact that you're taking the prevailing assets in the market and pricing the entire deal off that is very good, because each deal then recalibrates to prevailing real return potential for equity, the asset class. Okay, so if we page down. So this share, the one that we're talking about today, has existed for 19 years. I've been a 19-year investor, and this is where these shares are different to other shares. You can see on that graph we've depicted there, the blue line is our share price, Bloomberg Daily Real-Time Share Price, and the red line was the market over that entire 19-year period from 2004 to now. In the first period, you'll see the red line went up strongly, then came down. That was with the crash. Now, in that structure, Gary, the first phase, we used what we call a click option. A click option is something that gives you an annual evaluation, annual lock-in. So we were very lucky. The bad years we sat out and we captured the good years. So the little table at the bottom shows we made 35% while MSCI World was down just on 1. Okay, but when you get to the end of the 5 years, like you can see roll 1 depicted there, the investors then have the choice to keep the shares or sell them. So our clients capitalized that 35. That became part of their new base. And then we had roll 2, roll 3. We're now on to roll 4. So for me as an investor, I put in £100. I've had the share for 19 years. I never had any capital at risk because every 5 years, I reset the capital protection to where the last prevailing assets paid out. Okay. And because I never sold any of the shares, I never paid any capital gains or any other taxes, and I still have the shares. So the little box on the right of the screen shows the cumulative returns to investors. If you'd been in from the beginning, because £100 is now £300, you had grown by 6% per annum, including the major crash of 2008-9. So that's a $6 IRR, a pound, sorry, this is a pound share class, IRR. And if you compare that, Gary, to a lot of people buy auto calls or things that have a coupon type payout, that would have been like 10.5 per year for 19 years. Very important with no capital at risk. Okay, the competitive type products, they all have a barrier. The barrier is at 30 or 40 or someplace, and this has no downside on the equity market. Just the last 5 years, the return has been 60. And that would equate to 9.9 per year and 12 as an annual coupon type payment. Okay, so when do I pay tax here? I pay tax one day when I sell the shares. And how much tax do I pay? It depends on the profit in the foreign currency. So I'm sure you guys in all your advice or advising clients that if you're in a currency like we are, the currency teams to over time soften, it's nice to pay the tax and the profit in the foreign currency. Okay, but critically, you can defer that until one day when you sell the shares. So just to compare this now to a unit trust or a normal share portfolio or an ETF, in those assets, you also long the market. Okay, you're typically on the red line here, but you never have a lock-in. So you never have a date where whatever you made up to that point, you lock it in, and now you've got a new capital protection. So what happens to you as an investor? You invest for 40 years or 30 years or however long. Then one day is one day and it all melts down. And when it melts down, you wipe out money that took you 30 years to build or 40 years to build. Now, we don't think that's the ideal situation. We think it's better to have part of your core portfolio in this type of share, then you augment that with individual stocks and stock selection. Okay, so that your combination gives you a solid base where that capital protection is being locked in on a regular basis without you having to think about it, without you having to pick the day. And at that stage, it recalibrates to where markets are at and asset pricing is at. Okay, so if we page forward. Okay, so the credit risk is then to Morgan Stanley and to the three names. I'm going to just page 14 to show you it in practical terms. So how it works is that Morgan Stanley issues us with this note, and that's off the senior debt of Morgan Stanley. It's their normal deposits base. And the reference that they have is a third each, so it's not first to default, it's a third each to HSBC, Barclays, and SocGen. Now, just to reflect, Gary, if you think of a balance sheet of a bank, ordinarily the first person to lose is your ordinary shareholder, your general equity. Before they lose, the preference shareholder loses their money. Okay, so they stand one back from the ordinary shareholder. And then before them is your loss absorbent type debt. They call it like AT1 type debt. If you remember recently with Credit Suisse, those type of investors were complaining, and obviously the preference shareholders lost and the ordinary shareholders lost. But because banks are so highly regulated, typically the depositors and the tier 2 debt holders, they are very highly protected by the high degree of regulation in the country, plus all the assets of the shareholders, the preference shareholders, and the loss absorbent debt. So what we've done here, just to make it very practical, is to say if something happened to Morgan Stanley, the issue of the note, then let's say you had a 20% write-off of senior debt at Morgan Stanley, that would mean that 20% of that 100 didn't pay out. So you'd lose 20 of the 100. If Morgan Stanley was fine, but HSBC for some reason had a default of its tier 2 debt, then because that's a lower level of credit, you might write off as much as 50%. So, but that would only be 50% on a third of the money, hence a 16.7 write-off potential. But before any of that happens, we have a look at the key factors. Firstly, the market capitalization, the value of the ordinary shares on the stock exchange for Morgan Stanley is $139 billion, and that of HSBC, $161 billion. Okay, then in addition to that protection, we have the protection from the preference shares and the AT1 type debt, which ranks ahead of the debt we have. That's a further 22, 26. You can see the numbers there. So with the banks being highly regulated under Basel and quarterly have to submit, we think that you'll find what happened like with Credit Suisse recently, where at a point in time, the Swiss government intervened and said, okay, we need to get UBS to come and do a deal here. And we'll provide some liquidity to calm people down. And no one there who had tier 2 debt or senior debt lost, even in Credit Suisse. And we think that's the natural thing that'll happen. But, there's nothing in life that's got zero risk. And this is why, you would put this as a part of a portfolio. But importantly as well, Gary, all the rankings, the rating of the rating agencies of this individual paper is investment grade, much better rated than any piece of paper in South Africa. Now, just to put this for your listeners into perspective, even the smallest bank here, SocGen, which is the second biggest bank in France, is actually bigger than Standard Bank or First Rand. Okay, so our banks aren't as big as SocGen in market cap and in asset values. So so that's your protection is from those banks. And then, as I said, Gary, the option provider is the guy who gives us the best price amongst the 7 banks. So they're the big guys like JP Morgan and the like. Okay, so let's page forward. We'll see at the end of the questions on the credit. Just page 1 down. Okay, so as to from a investor's perspective, what one must be mindful is that what has been the long-term asset class performance, and this is how we put the cap at 40, Gary. We have a look at world equity, and we find that on a 120-year measure, the best asset class has been equities, because as you and I know, equities pass through inflation risk onto the consumer. Equities are represented, especially at index level, by the best shares that are amongst the shares, simply because the highest value shares have the highest weighting in the index. And so you would appreciate that at the moment, for instance, the S&P 500 is probably dominated by 11 or 12 stocks. Okay. And if one of those stocks or 3 of those stocks, however many of them, had a difficult period, they just have a lesser weighting in the index, and some other share would take over. So at index level, the price earnings ratios and evaluations seem a bit over the average, but you strip out those 10 or 11 and it's probably much more normal. Okay, so the point is that equities over the 120-year had an average of 8.2 per annum, bonds 5, and cash 3.7. But now for your participants here today, it's critical to look at real returns. So if you take that 120-year return and you then say, okay, but how much was the real return? Then you'll see the average inflation in the world was 2.9, much like it is today, I suspect. And that means your real returns are down to 5.3, 2.1, and 0.8. Now, if you care to compound that for 120 years, you get to 49,000, 1,100, and 160. Hence, not very smart to keep your money in cash for an extended period of time. The difficulty you have as an investor is if I say to you that, as I said up front, 52% of the time, either the equities or the bonds over 5 year down, but you don't have a mechanics to not take those loss periods. Okay, that's where your problem lies. It's not the good periods that count, it's the fact that sometimes you've got to have the losses. So in these shares, the way we've developed it is we've said, firstly, Gary, on that 8.2 average, that includes dividends and it's before fees. So if you strip out the dividend, because remember our exposure is without the dividend, then that would be about 1.7 off the 8.2, leaving you with plus minus 6.5. Compounded for 5 years is 40. Hence, we're comfortable to put the cap at 40. Because what we want as an investor is we want zero downside volatility on the 100, and we want 150 leveraged upside. So if the market then did that 40 and we got 60, on the balance of probability, we've done very well. So if you page forward, I think we're nearly finished. Just to refresh our minds and remind us that life is normally okay, but sometimes it's not. We've just put one of the shares, maybe for the listeners as well, Gary, just to give our long-term track record. We've now done 104 listings over a 20-year period, worldwide listings, not all the same type, but of them, 75 have matured. And of those 75 in 72 occasions, 96%, we gave the investor a profit. In 3 occasions, which was 4% of the time over 20 years, we gave them their cash back. And we've been very blessed, touch wood, not one investor in 20 years has lost any money. Now, that's enabled us. From when I joined, we had a few ideas, and we're now managing on 33 billion of client monies. 19,000 investors have invested, and as I say, we're very, very blessed with no losses. This graph just shows you a very, very important principle. The blue line is the MSCI World All Country Type Index. That red box is when we went through that GFC, the 2008-9 crash. Our share in this case only had 2 indices, the Nikkei and the Eurostoxx 50, and they went down 44%. Okay, over a 5.5 year day count. Our investors walked away unscathed. Now, what's important to understand, if your next door neighbor loses 44, the market's got to go up 44 on 56, which is 85%. You can invite him for a bribe because you didn't lose any. Okay, you'll never catch up. If you lose that type of money, it's very, very difficult to catch up. So what this graph shows you is that the important thing is, in a terrible period, replace the bad with a zero loss of your capital. Yes, you did lose the inflation for that period. And in a good period, lock in the performance. So if you've got these two forces together in the same offering, then it's a very high Sharpe ratio. It gives you a high reward potential for the risk you're taking. So let's page down. I think just one or two more. Okay, just to highlight another very important principle. This graph shows you volatility. So that spike there in the middle, Gary, is when we had COVID. That vols went up. And now in the most recent past, because we haven't had a down corrections, very vicious down corrections for some time, you can see those volatilities have come off nicely. That's why we can give 150 gearing. And even the 150 is very conservative. We're pricing as we speak, and it's probably going to trade 155 or 160, better than 150 anyway. Now, something that we don't think about as investors all the time is, how much would it cost me to protect something? Like, we take out car insurance, household insurance, medical insurance, building insurance, and typically there you pay a premium so that if you crash your car, sometimes pays for your car and the Ferrari, whatever you drove into. Okay. Now, in investment terms, if you were to buy a 5-year put option, a 5-year put option is to protect equities for 5 years, the premium would be 11%, 11.25 would be the cost to protect. So what I look at as an investor is, I'm getting this deal. My total fees, costs, and expenses for 5 years is a total of 7. What I'm getting free, like if I picked up the phone and asked just for insurance from any supplier, it'll be 11. 1.5 times what my total fees, costs, and expenses are. And the total fees, costs, and expenses are all built into the pricing. So it's, if I put in 100 and markets crash, I still get the 100 back. And I get this growth based on 100 as per our example that we gave. Okay, last point. let's just look at valuation in markets. And I think there is more you guys territory, but just in high level, we've seen the S&P trade, above its long-term average PE. But as I say, if you strip out the 10 or 11 stocks that are like really propelling it, the rest seem fairly much at long-term average. The Euro stocks we're seeing below its long-term average. The emerging markets also below, and the Nikkei close to, but a bit of an anomaly because of the yen and how the yen prices. But essentially, if you think of the macro picture, what you've had is interest rates have gone up like very strongly. The equity markets, to my mind, have held up quite well against that is very, very significant increase in rates. So what I think is either at some stage this bubble bursts and it all comes tumbling down if there's a recession or something really bad happens. So I want the capital protected. But if the rates moderate, as one would expect, especially now with the problems in the Middle East, or they come down, that'd be a great tailwind for equities. Okay, that's why if that happens, as an investor, you'd be well placed to have 150 gearing on the performance of the equities. So by being able to have the 150 geared upside, but the zero downside, that bodes well for part of your core portfolio, as opposed to buying an ETF or something where you just get a 1.5 dividend, but you only get 1-for-1. Okay, and you get no downside protection. And this is hence where we think it adds value. So valuation, I mean, you could go into that a lot more than me. We just think it's very difficult to time the markets. It's time in the market that makes you the money. And if you've got this type of structure, you can actually sort of be slightly wrong on your index basket combination or your timing because you've got the protection and the geared upside. Okay, last one, just as far as the Rand. Okay, so we obviously don't know what the Rand's going to do, but the forward market shows a further 23-24% devaluation over the next 5 years. And that can be a debate of whether the Rand cheap, expensive, we don't know. What we think is that if the investor hasn't got enough of their money overseas, it's the opportunities are much more overseas than here. And if you've got a dollar nest egg you're trying to create, it's very nice if a part of that nest egg, you don't get the eggs are broken. Okay, the eggs are all intact when you arrive. And then obviously that enables you to, in your mind, have security about your saving, is at least that is secure for that part of the allocation. Then the fees, the last one covers the fees. As I said, the fees are all built in, and it's effectively a cost provision for the lawyers, the auditors, the tax exemption of, we say 0.5%, but if you look at our fact sheets, Gary, you'll see that now these days, because of the size of these companies, comes out at about 20 basis points, 25 basis points. To get the regulation in 3 jurisdictions, 100% tax exemption, Grant Thornton giving you annual financial statements at 0.3 of 1% for 5 years. So quite a good deal. And then the distributors fees, which is your firm, ours are all built in, and that's a 0.6 each. And they don't impact the client's capital, and they don't impact their returns. Okay, so what we've also done, I won't get into that technicality, is we've bought, Gary, $130 million of this debt and put it on balance sheet at Investec. Okay, and it'll be transferred into the company in another 2 months' time when the subscriptions have come in. Importantly, that says that Investec is obviously very comfortable with this debt. Otherwise, we wouldn't buy it on our balance sheet. Secondly, just to protect investors against interest rates spiking up, we bought a thing called a swaption, which is an option on interest rates, 1% above the prevailing floating rate when we did that initial hedge. That's a bit technical, but that's just to say that obviously Investec is looking out to protect itself and the clients. So I think that's a good overview. Maybe we can take questions, or Gary, if there's something that you think we should expand on more, you pick that up.
No, perfect. Thanks, Japie. I think that was quite comprehensive. A couple of questions. Got one specifically around tax, but I think we're going to deal with that slightly differently because I'd rather have a tax practitioner cover that. But just in terms of the cost, also, I just want to kind of make one point, and then I'm going to ask you a question as well, because we've obviously got the cost slide up. The nice thing for retail investors, and this is something that perhaps people don't appreciate, is that normally when you're buying an instrument like this, you actually have to have a custodian holding it somewhere. and it's got to either sit in a broking account or it's got to sit in an offshore platform. That cost naturally is probably at least 1.5, at least 0.15, so 15 basis points. And if you're looking at kind of one of the more traditional platforms, they can easily slide up to sort of 30, 40, 50 basis points. But when we're doing an analysis on a client's portfolio, and we're looking at investment management fees, the asset management fees, all of the things, I mean, we quite regularly have a look at clients at other brokers, and we see that their all-in rate is maybe above 2%, 2 to 3%. So to be able to do this, and one of the things that I really like about these Investec products is that because it's the Guernsey company and you can actually invest in it directly, within that distribution fee, we don't charge any advisory fee over and above this. That advisor fee sits, we're quite happy with just the distributor fee. And the administration fee is also embedded in the product. So when you buy the product and if you put $100,000 in, essentially that goes into the Guernsey structure. You get the reporting, you get everything, you get almost the mechanics of the platform without having to then go and put it on a second platform and get these additional layers of fees, which is why these products are specifically nice. But then, just Japie, around the kind of the question around I'm just going to go back to the slide as well around the credit risk.
Yes.
Obviously, this one normally we see that specifically with a lot of these structured products that the issuer and the credit reference entity are the same. And I'm just interested from my point of view with the splitting of the credit reference entity, how much of a lift are you guys getting in terms of the performance?
Yeah, so that's
typically, if we had to just take Morgan Stanley as an issuer, for example, I mean, because I'm assuming you would either have to tweak you'd have to remove the 100% capital protection, or you'd have to via selling an option lower down, or you'd have to limit the amount of gearing that's on the upside. So I'm just interested in kind of with the splitting of these credit reference entities, like what kind of benefit is the ultimate investor receiving?
Yeah, sure. So just page up to where we did the pricing, and I'll show it to you. Just page up. I think it's about 2 or 3 pages. Go back to but yeah, just stop there, Gary. So can you see there the credit spread right at the bottom? The second last number is 1.6% per annum. Let me first put this into perspective for you. If you bought a SA government 5-year dollar bond, I haven't checked it this last week, but essentially you'd probably be paid about 2.4% spread above US government bonds for SA government. So to be paid 1.6 sort of reflects that it's like very good credit. I mean, because it's much better than, that's why it's fully investment grade. Now, if you didn't get that 1.6, you can see here, then that rate would be 5.3, 5.2, sorry. Okay, because it's 5.2 plus the 1.6, which gives you 6.8. So if you didn't get the 1.6 for 5 years, in simple language, that'd be 8% in money, 8% physical cash. Okay, 1.6 times 5. So you would either, so now you would either have to say to the client, the first 5 or 10% of the downside would be for your account, because you would need more money to, you'd need to have 80. You can see it here. Were you currently having to put down 72 to grow to 100? You'd need 80. So you'd either have to reduce the 21 to 13, your option spent, and if the at the money call spread cost 14 and you only had 13, you could give the client 100% capital protection, but only 95% of the upside until it hit 40. Now you're giving them 150% until it hit 40. So that's a good question, but that's about the calibration. So the question is a good question. Why would you be happy then to accept the tier 2 debt of those credit references? Is because one, you're getting a far superior priced product. Secondly, the capital which is protecting you from HSBC and those that information we shared about the money that has to lose before you is extremely significant amounts of money. Thirdly, probably the most important, is that the French government for SocGen, for instance, and the UK government for HSBC, they're monitoring and getting credit submissions quarterly from these banks, which are extremely onerous under Basel, and where these banks are being forced to keep high degrees of liquidity, solvency, capital, to protect their investors. And very importantly, those central governments with a quarterly submission, just tell them, listen, I see this ratio is getting low. Go to your shareholders and get more capital. So the point is, for the retail investor, for you and I, it's very difficult to capture two layers of benefit in one deposit. Okay. As Investec, because we go to Morgan Stanley with a $130 million check, they prepared to pay us 1.2% for their funding, which they would never pay you and I at 30 basis points. Okay, firstly. Secondly, the fact that we're ordering that amount of size and we've got all the credit specialists within the bank, we can make sure that we're being paid the appropriate for that credit reference. Now, the reason we split it between three banks is just simply we recognize that it is subordinated debt. It's subordinate to the depositor, and we want to be like really, really sure we don't lose a lot of the client's money. So we make sure that we then split it amongst three. So if one got into trouble, then it won't impact the others, and then you only have the loss, i.e., not the recovery of that in that structure. So I think what's key here is we as Investec have done this for 20 years. We've never had any entity not pay or not honor. So for an investor, you'd be wanting to buy this from a bank that has strong credit credentials, and most important is prepared to put their money where their mouth is. Actually sign a check for $130 million before they ask you to sign a check. So yeah, so that's really the reason, is that it enhances the return. So in simple terms, if I say to you, in history, only 38% of fund managers just buying the pure equity can beat the market after fees, costs, and expenses. You can appreciate that for us to beat it 95% of the time, it's the fact that we're capturing both the equity risk premium and the credit risk premium. We're capturing the three premiums of the asset classes. Okay. And the fact that you're doing it in this manner that we've discussed today is that you're only taking absolute default risk. You're not taking the deterioration in duration, credit, or equity as a risk. So it isn't very fair, I must say. It's not fair on a traditional process.
It's not fair on the traditional process. I like that. But and it's a very good point, because obviously a lot of the listeners today are retail investors as well. And I mean, I can tell you from our experience working with in the retail market, the first thing a retail investor thinks about is performance. And when you look at a wonderful performance chart like we had a little bit lower down here, where I kind of thought, let me just compare this. This is obviously the benchmark, which is the MSCI World. I thought, let me compare this to the S&P 500 over the same period. And you still only get to about 240%. So, I mean, even outperforming what many consider the best asset class. The problem is a lot of retail investors, they look at performance and they totally forget about the risk. The more savvy retail investors, they start to understand market risk. They understand that shares go up and down, and they understand that maybe they're not going to get, they might get their capital back. But I think it is important to just understand, the credit risk aspect of it as well, because that is something that I think a lot of people, they look at it as something that is almost exotic. They don't understand it, and then they shy away from it. And I think it's important to understand that really you would have to have the equity capital of these banks wiped out. It would have to be a systemic event. Just a quick follow-up question on that. In terms of you've got obviously the wonderful back testing graph looking at the history that we looked at here with the simulation. I'm interested to understand how Investec thinks about almost the back testing of credit risk in general. I mean, I'm assuming it's not an anecdotal process, and I know, as you mentioned, you've got a lot of very detailed credit analysts here. But in terms of the selection of these underlying reference entities, I mean, I'm just interested in the kind of process that Investec goes through to kind of decide, hey, we're going to go with SocGen and HSBC, for example, rather than a BNP Paribas. I mean, I'm assuming that's a very robust process that a retail client will never be able to perform those kind of calculations themselves.
Yeah, definitely. So just to give you an idea, Gary, for Investec to give us a $130 million check, firstly, we would not include a bank there that we're not doing regular business with, because they have to be on our radar, being monitored consistently by the bank in its interbank activities with those other banks. Okay. Secondly, we would not want to be holding that asset on the Investec's books in case people didn't buy it. where we had any concerns about those. So as part of the bank's own banking process, where it considers other banks, those are major parts of their deposits are placed with other banks, they would evaluate all those facts in that daily regular evaluation. So also at the end of the day, if someone wanted to sell these shares intermittently and we had to buy some of the stock back and put that debt back on our books, that our own bank would be the natural place for the secondary purchase buyback. So it's not like they just need to be happy today. They also need to be happy to say, well, if in 2 years' time or some point in time, we wanted to buy it back, yes, the asset would price in the market. So the debt would price, at the prevailing price of the credit, of the interest rate instrument at that point. But to provide liquidity, that's quite key. So in a roundabout way, as of today, we have roughly $100 million of secondary stock. 100 million rand, sorry, 100 million rand is the total value of secondary stock we have across all our businesses that are shares that are, and instruments that are live. That's on a base of 33 billion. Okay, so you can do the math. It's like a fraction of a percent. Why is that? It's simply because in our experience, also over 20 years, only 1 to 2% of people ever sell early, because investors recognize that firstly, what you find is, let's say you get a very bad period like you had there in 2008-9, and the market, the physical market, is down 40, and you look at your structured product, because of the construct, it will only be down 8 or 9, maybe 10. Okay, even though the equities are down 40. But here, that if I just keep it another 3 years till it matures, I'm going to get my 100 back. The normal investor is stressing because it's now, he put 100 in as worth 60 and he doesn't know where it's going. Okay. So firstly, the anxiety is very significant if you don't have a safety net. Okay. This is why we take out car insurance. This is why you take out medical aid. If I say to Gary, stop your medical aid next week, you're paying a lot of money unnecessarily. The first thing you're going to do is going to say to me, what if I get terminally ill? Where my family going to get money to pay that medical bill? It's the same with your investments. Most people don't have a mechanism to protect a part of their investments. Hence, when there's wars, when there's COVID, when there's events that are systemic to the world, why people get so anxious. And now the problem that they get is human nature takes you to a point where you take a certain loss absorbance. You're happy with a certain mark-to-market loss. And then you say, no, Mr. Fund Manager, Mr. Advisor, please cut. Please sell that lot out. And then every time he sees you, he reminds you that you lost his money. Okay. Because he doesn't know that he just needs to hold it until that day on the winner's sun sets to get his money back. Okay. So what the product is also designed to do is to help us with us as people, our anxiety. Now we don't sell something at a loss at the worst possible time, because we know that unless Morgan Stanley or those big banks have got a problem, you're going to walk out with your capital intact at maturity.
Yeah.
Hence, so few people sell.
Yeah, and I think that's a very important point as well. So we've seen that also with our client base. As you buy these products, and sometimes it's better almost not to give you a mark-to-market rate because it creates that anxiety. But what these products say on the tin is what they're going to do. Bar the credit reference, event. And often, with the market pricing, as we buy, when we first onboard any client, we try and explain to them as well. In the initial year, don't even expect this to be positive. What you're looking for is the return over the 5-year period. And I suppose the big benefit, of course, is the ability to then defer your tax almost indefinitely because it's structured as a share, and that you can continually roll the product. I just want to touch, so one question just on volatility. Obviously, with the Ukraine, at least with the Hamas-Israel conflict that we're seeing at the moment, we have seen a little bit of a spike in volatility. How does that affect the pricing? Now, I'm assuming that the options become a little bit more expensive because of the volatility, but I also know that Investec would never strike this product unless it was going to be on those tips. It's not like you're going to subscribe for this product and suddenly Investec's going to say, oh, you're only going to get 1.4 times. I mean, there's a hard cap that what it says on the tin is what you're going to get. But I am interested, in terms of the volatility, how much does this volatility need to move before the 24th to really negatively impact the product? And I suppose a follow-up question just from me, has there ever been a product that Investec has marketed that hasn't actually gone to market? Have you always built in enough fat?
Yeah. So let's just go back to pricing. Just take us to your pricing schedule. It's that page 5, and I'll show it you there. Yeah. Okay. So can you see this 18%, the call option, and the 4%? You see those two numbers. So the 18 is a purchase call option at spot. The 4 is a sold call option at a level of 140. So what you've done in this structure is you've got what we call a very low volatility impact, in the sense that you've bought volatility and you've sold volatility. If volatility goes up, down, sideways, they're both impacted. Okay, so it's just the volatility difference between a 0 and a 40 level. So I call it the smile technically, but it's very low impact on the pricing. If the structure was a 140% uncapped upside or 120% uncapped upside, you would have only bought volatility. Okay, so then if volatility spiked because there's a war, there's uncertainty, whatever, then the pricing moves massively against you. So here we've tested, and we test every 2 weeks. We tested again today with certain of the banks, and this is our expertise. Is we obviously option structures, and we got all the Black Scholes pricing, and so in this case, it's interesting, Gary, that the price of these options is actually more impacted these days by the interest rates than by volatility. Why? Because the interest rates affect the carry in the market, by how much the market should go up, because the dividend yields don't change that massively. But if the interest rates change, it changes the forward pricing of the assets. Okay, so yeah, so no, in this case, we're not stressed. And in fact, in the 104 listings we've had, we've never pulled a product. So in fact, the last 17 years we've had of these baskets, every trade has come at higher and a better gearing than what we've said. Because we end up not needing that 0.5% cost provision. We only need 25 basis points, and we obviously make sure that we don't overpromise. That's the key push. We do reserve the right. If you go to the first page, you'll see in there we do say we reserve the right to trade even if it's as low. Just go one forward. Yeah, just there you had it, page 3. Yeah, at the bottom there, we indicate that we have the right to trade if it's 145 or better. Now, we're saying 150, and I can say to you it's comfortably above 150. Why we can be quite certain is we've already bought the majority of the bonds. We've already bought $130 million of the bonds. Now, if we were a brokerage, or we were some business that couldn't afford and didn't have the management to give you the money to buy the bonds, that would be very difficult to do, because what are you going to know what it's going to be like priced in November, December? So hence, this is what gives us a lot of security on that. So volatility impact on this trade, not high. Where you see volatility impact on trades quite significant is things called auto calls, or things that have barrier risks. Why? Because there you're getting an income from writing an option. Here, we're only writing a call against an existing call. Okay, we're not writing a naked position.
Yeah, much more balanced. Okay, perfect. And that's, I think we've got 2 minutes left. So if there are no more questions, or if anyone has any other questions, please pose them, and I'll pose them to Japie just before the close. But otherwise, Japie, thank you very much for the insight today. It's always fantastic listening to you take us through these kinds of products. Obviously very complex products, and you do have just like an absolute depth of experience in those, and always able to tackle the difficult questions as well. I think from my side, one thing that I just picked up in the presentation, obviously, is something that Japie mentioned a couple of times, but really it's the fact that retail investors, for me, don't have the mechanics to do this kind of stuff themselves, and that's what's really, really important. It's easy to go out and invest in bonds or buy a bond fund. It's easy, as you're saying, to go and buy a balanced fund. It's easy to go and buy some equities. Platforms are designed to do that. The problem is it doesn't actually create the output. That is often the optimal output for you as an investor, who's someone that wants to maximize upside while minimizing their downside risk. And that's exactly what these products do. So thank you very much. Thanks for your time, Japie. And we hope to see you again soon. And obviously, for anyone watching the presentation, we are obviously taking applications. You literally just send an email to support@randsource.com. We're happy to take you through it in more detail. We're happy to obviously put it in the context of your personal portfolio as well. if you are unsure of what your weighting should be, or whether it should, the timing, etc. Those are all things that we assist you with as an advisor. We can kind of help you with your underlying allocation to these types of products. Of course, Japie also mentioned, the idea that it is a 100% offshore product. I know many of you are already sitting with US dollars, looking for a home for these US dollars. This is a great product to do that with. But I suppose maybe just a closing note from me as well. We obviously sit and do a lot of FX dealing also, through Investec's currency desk. And I think it's very important to understand that if you're waiting for the perfect rate, so often the dichotomy between buying dollars and entering the markets is opposite. When you have risk off trade, you're suddenly seeing the rand get weak, but that's also a fantastic time to enter a product. And when you've got a product here where we're going to have a reference to a growth basket, and let's say you've got US markets and the Euro stocks and the Nikkei, slightly softer, it's sometimes worth paying up a little bit in your currency trade so that you can get the lower entry point into the underlying market. So I'll leave it at that for today. Thanks for listening. And if you've got any questions, just send us an email. Thank you.
Thank you.